The first time I lost everything, I was not scared. I was certain. And that certainty, that unshakable, bone deep conviction that I understood what the market was doing and where it was going, cost me more than money. It cost me years. It cost me sleep. It cost me the version of myself that had walked into that trading room, believing he had already figured out what most men spent entire lifetimes chasing. My name is Jesse Livermore. At 15, I was beating grown men at their own game in the bucket shops of Boston, reading the tape with a speed and accuracy that made the older traders uncomfortable. At 30, I had made and lost fortunes that newspaper editors could not stop writing about. By the time Wall Street knew my name, I had already been destroyed and rebuilt twice. And I had learned something in those destructions that I could not have learned any other way. Something that no book and no mentor and no amount of theoretical study could have handed me. I had learned where the real power in the markets actually lives. It does not live in the 5-minute chart. It does not live in the clever entry or the precise exit or the perfect setup on the hourly time frame. The power lives in the higher time frame, always, without exception. And every trader who has ever lasted long enough in this game to build real wealth has understood this, whether they could articulate it or not. Today I'm going to tell you exactly why. Not as theory, not as strategy. As the hard-won truth of a man who had to lose everything multiple times before the market finally succeeded in teaching him what it had been trying to teach him from the beginning. Let me start with something honest about human nature, because you cannot understand the higher time frame principle without first understanding the psychology that works against it. We are impatient creatures, every one of us. I was impatient. I was brilliant and fast, and I could read the tape better than almost anyone alive. And I was still impatient, still driven by a hunger for action that the lower time frames fed perfectly. The 5-minute chart is a feast for impatient people. It gives you setups constantly. It gives you reasons to act, reasons to feel smart, reasons to be in the game, rather than sitting on the sidelines watching. Every tick produces a new piece of information. Every candle suggests a new possibility. The lower time frames understand what human psychology craves, and they deliver it without mercy. But here's what the lower time frames never tell you. They never tell you what the tide is doing. They show you the ripples on the surface of the water, the individual waves moving up the sand and retreating, the spray and the foam and the constant restless motion of the surface. And all of that surface motion is real. It is happening. But none of it tells you whether the ocean is coming in or going out. And if you are standing on that beach building your positions based entirely on the behavior of the ripples, you are going to lose everything when the tide comes in and sweeps it all away, every single time. I spent the first years of my trading life in the bucket shops watching individual price movements tick by tick. I was exceptional at it. I could feel the rhythm of a stock from its tape behavior in a way that other men could not. But I was reading sentences when I needed to be reading chapters. I was interpreting individual words without understanding the story they belonged to. Every time I took a position based on short-term momentum without checking what the larger time frame was actually doing, I was setting myself up for the same experience. Initial movement in my favor, a feeling of vindication, and then the reversal. The clean, brutal, total reversal that would not stop because it did not need to stop. It had the force of the actual trend behind it, the monthly trend, the weekly trend, the tide. And my little position based on a ripple was simply going to be erased the way all ripples eventually are. There is a specific trade I want to tell you about because it taught me this lesson in a way I never forgot. I had identified a major move developing on the monthly chart. This was the kind of setup that appeared once or twice in a year at most, the kind where multiple time frames were beginning to align and the potential was enormous. The monthly chart was building towards something significant. The weekly chart was showing the early stages of momentum. I was right. I knew I was right. But I was also impatient, and impatience does not ask for permission before it acts. I saw a pattern forming on the hourly chart that seemed to confirm the direction I already believed in. I entered early, weeks before the higher time frame had given me the signal I had been waiting for. I told myself it was just a small initial position. I told myself I was simply getting a head start. The market moved against me immediately. Not catastrophically, not the kind of move that forces you out of a trade the same day, but steadily, methodically, with the specific cruelty of a market that knows exactly how to test a trader's conviction. For 3 weeks, I sat in that losing position. Every day, the hourly chart gave me new reasons to believe the reversal was coming. Every day, the daily chart told me something different. And the monthly chart, the one I had started with, the one that had been right all along, was telling me that I had entered too early, that the larger story was still developing, that the time had not yet come. I finally exited at a significant loss. 2 months later, the move I had identified materialized exactly as I had expected. The monthly chart did what it had always been going to do, and I watched it happen from the outside, having spent my capital and my patience fighting the very time frame I should have been following from the beginning. That experience crystallized something that I had intellectually understood, but had never felt all the way through to my bones. The higher time frame sets the direction. Everything else is commentary. The daily chart tells you the rhythm of that direction, the pace at which it is moving, whether conditions are right for entry or whether patience is still required. The lower time frames, if you use them at all, are only useful for precision and execution once the higher time frames have already confirmed where you are going. You never use a lower time frame to make a decision that should be made on a higher one. That is like asking a ripple for information about the tide. Here is what happens at the institutional level, and this matters because the institutions are the tide. The banks, the funds, the large commercial operators who move markets rather than following them, they are not watching 5-minute charts. They are not building positions based on hourly setups. They are operating on weekly and monthly time frames because that is the only scale at which positions large enough to matter can be constructed and managed without destroying themselves in the process. When an institution decides it wants to accumulate a position in something, it takes weeks, sometimes months. The accumulation leaves patterns on the higher time frames that a trained eye can recognize. The quiet coiling of price, the compression of volatility before the expansion, the way volume behaves when large money is moving carefully and deliberately rather than emotionally. None of that is visible on a 5-minute chart. You cannot see the ocean from inside a single wave. And when the institution finally moves its position, when the accumulation is complete and the campaign begins in earnest, the lower time frame traders who have been playing against that direction will be swept away without the market so much as noticing they existed. Think about the psychological experience of the trader who ignores higher time frames. He sees a beautiful setup on the 15-minute chart. Textbook formation. Perfect. He enters with confidence. The trade moves in his favor initially, enough to reinforce his belief in the setup. Then it reverses. He checks his 15-minute chart. The setup still looks valid. He holds. The reversal continues. He checks the hourly chart now, looking for reassurance. The hourly chart is beginning to turn against him. He tells himself it is just noise, just a pullback, that the 15-minute setup is still good. The daily chart is screaming a downtrend, but he is not looking at the daily chart anymore because the daily chart is telling him something he does not want to hear. He holds. He hopes. He adjusts his stop downward to give the trade more room. And then the real trend, the one on the daily and weekly charts, the one that was always going to win, finishes the job. This is not bad luck. This is not the market being unfair. This is what always happens when you trade a lower time frame against a higher one. The higher time frame has more capital behind it, more time behind it, more conviction behind it, and it will always outlast anything operating in the opposite direction on a smaller scale. I want to talk about patience now because this is where most traders, including the intelligent ones, the ones who understand everything I have described intellectually, fail in practice. Knowing that higher time frames are more powerful does not automatically give you the patience to wait for them to align. The waiting is the hardest part of this entire discipline, not because it requires physical effort, because it requires you to do nothing while something appears to be happening. The market moves. Setups form on lower time frames. People around you take trades. Social media fills with wins and losses and commentary and analysis. Every hour of inaction feels like an hour of missed opportunity. Your mind constructs elaborate arguments for why this particular lower time frame setup is different, why this one is good enough, why the higher time frame will catch up to what you are seeing on the smaller one. These arguments are brilliant. They are detailed. They are completely convincing. And they are almost always wrong. I knew a trader in New York, a man of genuine intelligence and real market knowledge, who understood everything about time frame hierarchy in theory. He could explain it better than most men twice his experience, but he could not wait. Watching the market move without being in a position caused him a specific psychological distress that he had never learned to tolerate. He described it once as feeling like being late for something important, a constant low-level urgency that made sitting still feel like failure. He was always in a trade. He had to be. The periods between trades were not rest periods or observation periods for him. They were periods of mounting anxiety that he resolved by finding a reason to enter. And his results reflected this exactly. He made money when the market trended clearly on higher time frames because even his imprecise entries were aligned with the larger move. He lost consistently during consolidation periods when there was no clear higher time frame trend because he kept entering based on lower time frame patterns that had no anchor in anything larger. He never made the connection between his losses and his inability to do nothing. He kept looking for better systems, better indicators, better entry techniques, when the only thing that needed to change was his relationship with inaction. The patience that higher time frame trading requires is not the passive patience of someone waiting for a bus. It is the active patience of a hunter. You are not idle. You are watching. You are studying the higher time frames constantly, understanding how they are developing, tracking the progression of the trend or the nature of the consolidation, building your picture of what the market is actually doing as opposed to what the moment-to-moment noise suggests. You are preparing. You are ready. And when the higher time frame finally gives you the signal you have been waiting for, weeks or months of preparation collapse into a single moment of absolute clarity. You know the direction. You know the structure. You know your entry and your exit and your risk. And you act without hesitation, without second guessing, without the tortured ambivalence of someone who is not sure whether the setup is real because they have not done the higher time frame work to know. Let me describe the experience of a trade done correctly from the higher time frame perspective, because I want you to understand what you are working toward. The weekly chart has been in a clear trend for months. The daily chart has been moving in waves within that trend, advancing and pulling back and advancing again in the rhythmic pattern that trends produce. You have been watching both for weeks. You know the trend. You know the rhythm. You know approximately where the next pullback is likely to find support based on the structure the higher time frames have built. The pullback comes. The daily chart begins to show the early signs that it is ending, that the buyers who were absent during the pullback are beginning to return. You look at the lower time frame only to calibrate your entry within the range the daily chart has identified. You enter. Your stop is placed below a level that the higher time frame has defined as meaningful. And then you do something that feels impossible to traders who have never done it. You walk away. You stop watching the screen. You trust the higher time frame analysis you have done, and you let the trade run. The daily and hourly noise that would have had you adjusting and second guessing and ultimately exiting too early becomes irrelevant Because your framework is not built on the daily and hourly noise. It is built on the weekly trend. And the weekly trend does not change every afternoon. 3 weeks later, the weekly chart has carried your position through multiple daily fluctuations that would have shaken out any trader whose analysis was not anchored to something larger. The profit is real, not the kind of profit that comes from being clever. The kind that comes from being right at the level that actually matters and having the patience to let that rightness express itself in price. There is one more thing I want to say before I close, and it is perhaps the most important thing. The higher time frame does not just improve your trading results, it improves your trading mind. When you commit to this approach fully, something changes in how you relate to the market. You stop trying to extract meaning from noise. You stop reacting to every price movement as if it contains information critical to your position. You develop the capacity to distinguish between what is happening and what matters, and you discover that most of what appears to be happening does not matter at all when viewed from sufficient height. The 1,000-foot view makes decisions that the ground level view makes agonizing feel almost obvious. Not because the market becomes simpler, but because you have stopped asking it questions it was never designed to answer on the time frames where you were asking them. I spent decades learning what I am telling you now. I learned it through losses that would have ended most people. I learned it through periods of reconstruction where I had to start with nothing and rebuild every assumption I had made about where trading intelligence actually lived. It does not live in speed. It does not live in activity. It does not live in the ability to read a 5-minute chart with extraordinary precision. It lives in patience. It lives in the willingness to study the higher time frame until you understand it well enough to trust it. It lives in the discipline to do nothing until the larger picture gives you permission to act, and then the courage to act fully and hold the position until the larger picture tells you it is over. The higher time frame always wins. This is not preference. This is not philosophy. This is the single most reliable observation I made across an entire lifetime in the markets, through booms and panics and wars and recoveries, and all the noise that filled the years between. The tide is always stronger than the wave. The river always knows where it is going, even when the eddies at the surface suggest confusion. Your job is not to outsmart the market on its smallest scale. Your job is to align yourself with its largest scale and have the patience to stay there until the current has carried you where it was always going to carry you. Everything else is just noise. And noise, no matter how convincing it sounds in the moment, never wins.